Okay, so let's go back up to section 3, price and earnings momentum multivariate analysis. So the prior studies in section 2 were univariate, where each of the earnings momentum and price momentum strategies were looked at on their own. However, here we'll have multiple variables in the regression. So with section A, we have two-way analysis of price and earnings momentum. And so first, we're going to rank the securities according to their past 6-month returns and assign them to 3 equally sized portfolios. And then within each of those portfolios, we will group them according to their recent earnings surprise. So this will give us 9 different portfolios. And table 6 presents the results of this study. So let's go down to table 6. Okay, so let's see how this table is structured. So in this row we have the prior 6-month return, and so remember these are ranked by their prior 6-month return. So here would be the highest past 6-month return, and here would be the lowest. And then within each of these groups, they are further ranked by their abnormal announcement return. So this will be like the abnormal return around earnings announcement dates, the 3-day period, as was done in the prior table. So for instance here, portfolios number 3 have the highest past 6-month returns, and those are further split into where this 3 is the highest abnormal return around the announcement dates within this group. And down here in panel B, we have the same situation, only within the past 6-month return groups, they're ranked by their SU, as was done in the prior tables. And then panel C is done the same way, with the ranked by the prior 6-month returns, but they're ranked by the past analyst revisions, as was done in the prior tables. So let's go back and take a look at the results. So we can see across these tables there's a consistent story. The highest past 6-month return group returns exceed those of the 2 and exceed the returns of the lowest ranked past 6-month returns. And there's also a monotonic increase within the subgroups where we're combining it with abnormal announcement return. And so this occurs over the first 6 months as well as the first year, but stops around the 2nd and 3rd year, which was found in the prior tables as well. And so we can see the returns of the highest ranked portfolio, that's the 3 and 3, is more than double the return of the lowest ranked portfolios of 1 and 1. And this same occurrence happens with the SU, just like it did with the ranking by the abnormal return around the earnings announcements, as well as the analyst revisions. And so what we find here is that using price momentum, which would be using the prior 6-month return, in conjunction with earnings momentum, actually kind of increases the returns, and they don't subsume each other. They both have their own ways of increasing the returns and they don't necessarily replace each other. But the interesting thing to note here is that using the price momentum part, the high excess returns extend out for a year when excluding the earnings momentum piece. However, when using just the earnings momentum piece and excluding the price return piece, the excess returns only extend out for 6 months. And the way we determine this is like so. So to see how the earnings announcement piece returns irrespective of the price return piece, we look at each of the 3s, 13.5, 11.1, 7.9. We sum them and divide by 3 to get the average. And then we compare that to all the ones in the abnormal return column, the 10%, 8.6, 5.6. And we sum them and divide by 3 to get the average. And we do that for the first 6 months and for the whole first year. And what we find is the return over those, or the 3s minus the 1s in the first 6 months, is about 2.8% spread. However, in the first year, in total, the spread is about 3.8%. So you would think that since a year is double 6 months, that the full year spread would be about double the first 6 months, but that's not the case. So it seems when taking into account just the earnings momentum piece, the first 6 months do better than the second 6 months. And however, when you do the same thing for only the price momentum piece, the price momentum of the first year is about double the price momentum spread in the first 6 months. So it seems like using price momentum lingers on for the full year, but using earnings momentum seems to trail off after the first 6 months. And this generally occurs across all of the earnings momentum types, such as the SU, the abnormal return around the earnings announcement dates, and analyst forecasts. So the authors offer a possible explanation for why this is occurring, so let's take a look at their explanation. So what they explain here is that the earnings momentum piece is very much isolated towards near-term effects of income. So for instance, the quarterly earnings or the analyst forecasts over the past 6 months and so on. However, with the price momentum piece, we're looking at very big revisions about the firm's future outlook, which could be very long-term. So it makes sense that the earnings momentum piece would have a short-term effect on returns, whereas the price momentum effect would be a bit longer term. And in fact, if you remember back from the prior tables, the highest decile portfolio returned 70% in the past 6 months, whereas the lowest ranked lost 30% in the past 6 months. So a change that large would mean that something really big happened at the company to cause it, and is very unlikely to just be a quarter-to-quarter response. And adding to that, the earnings momentum strategy is a very narrow piece of the value of a company. So it would make sense that those items of information would be absorbed into the stock price relatively quickly. However, looking at the past 6 month returns could mean a large number of different reasons that may take longer to get into the stock prices. And so panels D and E from table 6 put the earnings surprise, the different measures of the earnings surprise against each other. So let's look and see the results of which one performs better. So these tables are done in the same way as tables A through C, only we're first ranking by the SU and then getting subsamples of ranks of the analyst forecast revision. And down at panel E, we first rank by the abnormal return around earnings announcements, and then by the revision in analyst forecasts. So table D compares the SU to the abnormal return around the earnings announcement. And so as we can see, the spreads between the SU and the abnormal return are about the same, 12.1% versus 5.1, 12.6 versus 4.8. And even while holding one of them constant, and comparing, they end up having about the same result. So we find that using the abnormal return or the standard unexpected earnings doesn't really matter as far as which one earns the best return. And they're both using different information to earn those returns. Okay, so let's go down to section 3B, where we'll talk about the cross-sectional regression. So we're going to use the Fama-Macbeth regression. So every month they're going to fit a cross-sectional regression of individual stock returns on the prior 6-month return with various measures of the earnings surprise. So we've used the SU, ABR, and the Rev 6. And so they also add in the firm size. And they also make it to where the variables are on a scale of 0 to 1, so their coefficients can be compared easily. And so the dependent variable is going to be the 6-month return or the 1-year return. And Table 7 presents this information, so let's go down to Table 7 to see the results. And so we have here panel A, which shows the 6-month return, and panel B, which shows the 1-year return. And we have here the size, the past 6-month returns, the abnormal returns over the announcement date, the SU, and the analyst revisions piece. And so here we have each of the coefficients for each of the earnings momentum variables stand alone, and you can see that the return is significantly explained by each of these earnings momentum pieces when standalone. These T statistics are very high for each of them, and they have positive coefficients. Using the prior 6-month return, the slope for the regression is 5.7%, and it's about 4.1 times its standard error. And we've got similar results for ABRs, 3.7, 6%, and they all have very high coefficients relative to their standard deviation or standard error. And when we look at the regression with all 3 earnings measures, we find that each one significantly contributes to the return. And this is in line with what we found previously, where each of the earnings momentum measures contributes its own piece using different information. And we see when we put all 4 of the variables, that's the price momentum piece, the past 6-month returns, with all of the earnings momentum pieces, that earnings momentum somewhat takes away from the price momentum piece. See, it goes from 5.7 to 2.9%. And we also notice that the SU and the analyst revisions pieces are just as important as are the past 6-month returns, because their coefficients are about the same. So now let's take a look at panel B, which has the 1-year returns. So when we use the past 6-month returns alone in the regression, its slope is 10.3%. But introducing all of the earnings surprise variables into the regression drops it down to 7.6. But regardless, the slope for the past 6-month return is high, not only nominally but also as a multiplier of its standard deviation, and it's much higher than was in the 6-month return panel, and also compared to the other variables in the equation, which have much lower coefficients and T statistics. And this is in line with what was found in prior tables, where the price momentum piece has a longer lasting effect than the earnings momentum piece. Okay, so let's go down to section 4. Are price and earnings momentum subsequently corrected? And so, as was determined in prior tables, the raw returns from the top-ranked portfolio minus the bottom-ranked portfolios aren't that much different in the second and third years following the portfolio formation. However, if you remember in the extreme portfolios, for instance 1 and 10, the stocks were a lot smaller than the ones in the middle. And also, if you remember, for the winner portfolio, they're mostly composed of growth stock. So since they're smaller, they exhibit maybe a higher return, but that return is dampened because they're growth stocks rather than value stocks. So they kind of cancel each other out, and it makes it difficult to see whether there's actually a reversal in the winner portfolio. However, it's noted that for the extreme loser portfolio, the returns tend to stay low with their smaller capitalization and their higher book-to-market ratio, which was exemplified to stress. And we also found that using the prior earnings surprise as the metric rather than the past 6-month returns, there's not really a return reversal there either in the second and third years. And even in table 6, where we used a combination of two different variables, we found that there's certainly a difference between the top-ranked portfolio and the bottom-ranked portfolio through the first year. However, there's not much difference in the second and third years. For example, in the second and third years, the returns of the top portfolios aren't that different than the average return across all of the portfolios. However, we do have a persistence and poor performance for the lowest ranked portfolios. For instance, the one that had poor price performance as well as bad earnings news. Those portfolios seem to underperform the average continuing into future years of 2 and 3 years out. And so the reason it may take longer for these stocks to come to their fundamental value may be due to the fact that it's more difficult to make short positions than long positions, which would move the stocks faster. And also, as we discussed previously, the security analysts are hesitant to make negative announcements about the stocks. So let's go back up to table 6 and dig in a little deeper. So it's interesting to note when the past 6-month return is combined with the abnormal announcement return. For instance, for the first year, the return is 27%, whereas when it's the past 6-month highest returns are teamed up with the lowest earnings announcement ranking, the return is only 21.3%, which isn't that much different than the average return across all portfolios. And this same occurrence occurs across all of the different earnings surprise measures. However, we see in the second year, in the column where the past 6-month returns is used but isn't confirmed by abnormal announcement return, that return is actually 18.3%, which is below the average return across all the stocks. So we could say that when the prior 6-month return is not confirmed with good earnings news, then we do see a reversal. However, when the prior 6-month return is confirmed by good earnings news, we don't see a reversal in subsequent periods. Okay, so let's go down to section 5 and look at some other tests. Section 5A would be the price and earnings momentum for large stocks. Okay. Okay, so using larger stocks here in analysis gives us better information that's more practical from an investment purposes. So tables 8 and 9 provide the results for this. So let's go down to tables 8 and 9. So here we have the same general tables as we've been using previously in this paper. But to be included in these portfolios, the stocks market capitalizations have to be above the median of the overall New York Stock Exchange issues. And so in panel A, we have the univariate results. The first row would be the prior 6-month return. Then we have the SU and the ABR and the Rev 6, it's the analysts' forecast revisions, and looking at their returns individually, and ranked the highest in portfolio 10 and the lowest in portfolio 1. And in panel B, we have the two ranking systems as we've seen in the previous tables, with being first ranked by the prior 6-month return and then by the different earnings surprise measures. And these are all, the results here are all 1-year returns. And it's interesting to see that even though these stocks are the largest on the exchange and should have the most public and accessible information, we still see a difference in the top ranked portfolios and the lowest ranked portfolios. And the difference here is about 14% between the top and the bottom using the prior 6-month return. And that's about the same as was seen in portfolio in the prior table, I think table 2, where all of the stocks were used and not just the largest. And here we see, looking at the different earnings surprise measures, there's still a small difference between the top and the bottom ranked portfolios, with the analyst revisions being the largest of the earnings momentum pieces, as was found in prior tables. And so taking a look at table B, or panel B, and so here we see that the top ranked 3-3 portfolio significantly exceeds the return of the 1-1 per portfolio, and that's across all of the earnings measures. And we see that adding in the earnings surprise rank, the 3 rank is higher than the 1 rank returns across the different earnings measures. So we still see that there's some explanatory help from the earnings surprise measure. However, we can see these differences aren't really as pronounced as they were found in the prior table, which included all of the stocks. And this makes sense because the larger companies have more public information and their earnings are maybe more predictable. So table 9 includes the regressions that we saw and used in a prior table, but here we have just for the large companies. And we see that we have the same results where these measures taken individually are significant. But when you include the price momentum with all of the earnings measures, the price momentum is certainly the most important, and the earnings measures seem to become less significant. Okay, so let's go back up to section 5B, where we're going to adjust this for the size and book to market factor. And so we found before that the prior earnings surprises and the price momentum results of the study may be due to the effects of book to market or firm size. So we're going to see if these excess momentum returns can be explained by the size and book to market ratio. And so this is done with Fama French's 3-factor model. And from this equation we have the return on the portfolio less the risk-free rate equals an alpha figure plus the market return piece plus the small minus big plus the high minus low plus an error term. And so if size and book to market are truly the drivers of this return, then the alpha figure should be 0 because these variables fully explained the return. So there should be no excess return over the return that should be earned with just these variables. And so table 10 has the results of this regression. So let's go down and see the results in table 10. So we have here the coefficients of the regression, and we have a row that shows the results of the winner portfolio. That would be the one that's was ranked 10, and the loser portfolios, which was the one that's ranked 1. And we have the alpha figure as well as the slopes or the coefficients for the market piece, the size piece, and the high minus low. And we also have an R-squared here to see how fully each of these variables explains the return. And these are for 6-month returns. And we also have a difference here. That would be the difference of the winner portfolio and the loser portfolio, as if you had simultaneously bought and sold the winner and loser portfolio respectively. So some initial observations regarding the book to market ratio. The winners are negatively affected by the book to market ratio, which would confirm some of our prior results where the winner portfolio tends to be glamour stocks or growth stocks, and the loser portfolio seems to be value stock. And the winner and loser portfolios seem to have similar market risk exposures, although the losers seem to be slightly higher. And for both groups, the size seems to be a highly significant source of returns, but their coefficients are very similar. In particular to note is the very high coefficient for losers. So typically with the smaller size and being a value company, they should earn more, and that's why these are positive. However, it's interesting to see they have such significant persistent low return. And so buying the winner portfolio and selling the loser portfolio earned 1.43% per month in risk-adjusted returns, and it comes with a very high T statistic, so we know it's very significant. And also note the R-squareds here of these are very high, so these regressions significantly explain the returns. And we can see that the past 6-month return adds to this explanation, and it's very significant in predicting the excess return. Okay, so let's go down to the conclusion and sum up what we've found. So the purpose of this paper was to better understand the source of why the momentum profits work. And in the past, there have been a lot of studies that explored the contrarian strategies, but there hasn't been much along the lines of persistence or momentum strategies. And in fact, the momentum excess profits have just been explained as just the normal cross-section of expected return. And so this paper set out to explore 2 different unresolved puzzles, and that's why are the past 6-month returns and the most recent earnings surprises helpful in predicting future returns. And so in the study, they used different types of earnings surprise measures, for instance, the SU, the ABR, and the Rev6, which is the analyst forecast revision. And what they found was using the price momentum effect, which would be the past 6-month returns, is a lot stronger and it lasts longer than the earnings momentum effect, which would be ranking by the different earnings measures, surprise measures. And so most of the evidence found that the future excess returns are not subsequently reversed. So that means that there's not a positive feedback trading phenomenon. And most notable, the worst ranked portfolios in the momentum strategies continue to perform poorly up to 3 years afterwards. And it was also found that if price momentum ranked portfolios are supported by earnings momentum news, then they don't reverse in the future. However, if they're not validated by good earnings news, then they do reverse in the future. And so, since the excess returns that are earned in the first year aren't continuing to be earned in future years, it's tough to say that these excess momentum returns are actually due to more risk. And also, we found in the Fama-French three-factor model that these excess returns can't be explained by size or growth value effects either. So a possible explanation is that the market responds gradually to new information. In order to test this, news around earnings announcements was used to see the effect of market return. And it was found that returns around these announcement dates did contribute substantially to the total momentum returns. For instance, about 41% of the performance in the first 6 months of the strategy occurs around announcement of earnings dates. And if the market is surprised by good or bad news, then the market continues to be surprised over the next few quarters. And so the other portion that moves the momentum profits may be due to other pieces of information that move stock prices. So, for instance, buybacks, insider trading, future prospects for the firm. So another cause of sluggish response to market prices may be due to the analyst forecast revisions being slow, and this may be caused by their reluctance to announce negative news for risk of alienating themselves from the company's management. And this may cause investors to take a while in taking action on these forecasts. And so it was also found that each of the variables, including the price momentum piece, which is the past 6-month return, as well as the earnings surprise pieces, each added their own predictive power for the post-formation return. And in a regression of the price momentum and earnings surprise variables, each of the variables tended to be significant in explaining the returns. So each momentum strategy draws upon its own market underreaction to its own information. And the authors point out that they're not claiming complete informational inefficiency of the stock market because looking at the prior 6 months returns, which were used to rank the stocks, the stock prices were somewhat adjusted to the new information, but not fully. For example, when looking at the past 6-month returns, the top portfolios exhibited 100% more return than the bottom portfolios. However, in the next 6 months, the difference is only 15% spread. So a lot of the information was incorporated into the stock price before the portfolio was formed. And so the authors point out some practical issues with momentum strategies and actually implementing them in real life. They note that a lot of the strategies that they have incorporated into this paper included short positions, which may be difficult for an investor to employ. Also, a lot of the stocks with high momentum tend to be smaller, and so they may have high trading costs. And also, implementing a momentum strategy tends to have a lot of trades. So overall, it could be a costly trading strategy. And to show an example here, buying the top decile portfolio gets a 27% return, which was 5% higher than the 22% return of the average across all the stocks. But with trading costs added in, which may be about 3%, then you're only netting about a 2% above the market. And so finally they found that stocks with low past returns also have low subsequent returns, and this may be conducive to a contrarian approach where the stock may have high subsequent returns in the future. The common result here is that investors tend to anchor on prior information rather than adjusting fully the new information into their pricing. And it's noted that the difference between momentum and contrarian approaches may be due to time period. For instance, in the momentum strategy, the immediate past, like the past 6 months, was used to extrapolate the returns. However, using more of a long-term past returns as the ranking system produces about the same return as the average. And from a contrarian standpoint, the focus is on stocks over a prolonged past period. If there's been a history of disappointments over a long period of time, there may be excessive pessimism for the stock that a prudent investor could exploit, because the companies may not be as bad as the market perceives them to be, but it typically takes a long time for those stocks to reverse. And prior studies have found that it could take several years for this to draw out. And that means that the reversals could occur for several years going into the future as well. And so for both strategies, this supports investors' tendency to overweight the past and extrapolate too far into the future.